Welcome to Talk Tickers. We're the show that delivers the crucial insights in the financial world that you need to stay ahead. And today, we are diving deep into a really critical set of rules for any active investor. We're talking about the fine print on capital losses, on basis, and that notorious 61-day window that can just erase the tax deductions you're accounting on. This is all about making sure that when you realize a loss, you actually capture it.
Exactly. This is where trading strategy really meets tax compliance. We're charting the territory where it's not just about what you bought and sold, but when, and maybe even more importantly, who did the buying and selling.
Okay, so let's start with a quick snapshot. The whole mechanism we're discussing today is the wash sale rule.
Right. And it's designed with a very simple purpose to stop investors from claiming a tax loss while, basically keeping their exact same economic position in an asset.
So the 61-day window, how does that actually work?
It's strict. A loss from a sale of a stock or a security is disallowed if you acquire substantially identical property 30 days before or 30 days after the sale date. So that creates this 61-day period you have to be incredibly careful with.
And what's the consequence?
Yeah.
A lot of people think the loss is just gone forever if they trigger the rule.
That's a common misconception. It's not permanently disallowed. It's deferred.
Deferred. So what does that mean in practice?
The disallowed loss amount gets added to the basis of the new, substantially identical property you bought, the replacement position.
And the holding period of the original asset gets tacked onto the new one as well.
Exactly. And that's a huge trap we need to talk more about.
And this rule is broad. It even applies if you do the repurchase in a tax-advantaged account, like an IRA, right?
Oh, absolutely. That's one of the most painful ways to trigger it. The loss is disallowed in your taxable account, but you get no basis adjustment in the IRA. The loss effectively just disappears.
Okay, let's get into the history here because the entire rule hinges on that one phrase, substantially identical.
It does. The rule was created to target sales that were purely for tax reasons without the investor really giving up the investment.
And substantially identical is more than just the same ticker symbol.
Much more. It includes buying a contract or an option to buy that same security, or even acquiring it in some kind of taxable exchange.
But there are some clear lines. For example, if I sell, say, common stock of a corporation, can I buy their bonds?
Generally, yes. Bonds or even preferred stock of a company are usually not considered substantially identical to the common stock.
Why not?
Because the rights and risks are fundamentally different. You've given up your equity position for a debt position. They're just not the same economic animal.
But there's always a but.
For what?
What about convertible preferred stock?
Now that's where it gets tricky. If that convertible preferred stock has the same voting rights, the same dividend restrictions, and trades at a price that almost perfectly tracks the common stock,
then the IRS says it's basically the same thing.
Pretty much. If it's unrestricted and acts just like the common stock, it can be deemed substantially identical, and the wash sale rule would apply.
This leads us into an even more complex area, a point of real legal tension. I'm talking about related parties, spouses, corporations you own.
Right. And this is where we have two different sections of the tax code clashing. Historically, the wash sale rule itself, that's Code Section 1091, has been interpreted by courts as applying on a taxpayer by taxpayer basis.
Meaning if I sell and my spouse buys, Section 1091 might not technically apply to me, the seller.
On its own, perhaps not. But, and this is a huge but, the IRS has another tool. It's Section 267.
The related party rule.
Exactly. And if transactions between related parties, like a husband and wife, happen almost simultaneously on an exchange, the courts can call it an indirect sale.
So what's the test? How do they decide?
It all comes down to whether the seller truly gave up dominion and control. If they didn't, if the stock just effectively moved from one pocket to another, Section 267 kicks in, and that's much, much worse.
Worse than a wash sale. Why?
Because under the wash sale rule, 1091, your loss is deferred. You get it back later through a higher cost basis. It's an inconvenience.
But under 267?
Under 267, the loss is permanently disallowed.
Permanently.
It's gone. It just vanishes. You take the economic hit, but you get zero tax benefit for it, ever. It is the costliest mistake in this area.
Wow. Okay, that really underscores the need for careful planning. Which brings us to penalties. What happens if you get too aggressive with this stuff?
The penalties can be severe. If the IRS deems a strategy an abusive tax shelter, you could be looking at a 20, 30, or even 40% accuracy-related penalty.
And in extreme cases.
If they can prove fraud, it's a 75% civil fraud penalty.
And there are specific reporting requirements for big losses too, aren't there?
Yes, what they call a loss transaction. For an individual, you have to file a special disclosure if you have a deductible loss of $2 million in 1 year.
Or $4 million across a few years.
Right. And for foreign currency, the threshold is much lower, just $50,000 in a single year. It's basically a way of forcing you to raise your hand and say, hey, IRS, look at this complex transaction.
And all of this is subject to the economic substance doctrine.
That's the ultimate backstop for the IRS. Does the transaction make any business sense apart from the tax benefits? If not, it can be disallowed.
And the penalty for that.
It can be 40% if the transaction wasn't properly disclosed.
Yeah.
They really penalize hiding these things.
Okay, that's a powerful incentive to be transparent. Let's pivot to how these rules apply in the modern world. Let's start with ETFs.
Right. ETFs have become a very common strategy to avoid the wash sale rule.
How so?
Well, the classic example is you sell an individual stock at a loss. Let's say you sell a healthcare stock and you immediately buy a broad healthcare sector ETF.
Since the ETF is a basket of stocks, it's not substantially identical to the single stock you sold.
Correct. That's generally considered a safe and legitimate way to harvest a loss while keeping your exposure to that sector.
Okay, but that's the clean example. Let's get into the gray area, the big one.
2 ETFs tracking the same index.
Exactly. I sell the State Street S&P 500 ETF, SPY, at a loss. Minutes later, I buy the Vanguard S&P 500 ETF, VOO.
Same index, different issuer, different expense ratio.
Are they substantially identical?
And that is the great unresolved question. The IRS has been very careful not to issue a definitive ruling on this.
So it's a use-at-your-own-risk situation.
For now, yes. You can argue they are different legal instruments. The IRS could argue their economic substance is identical. It's a significant gray area that active investors use, but it comes with regulatory risks.
A risk that the rules could change and suddenly make that strategy invalid.
Precisely. Any tightening there would impact a lot of people.
Okay, so if equities and ETFs are complex, let's talk about instruments with their own special rules, like Section 1256 contracts.
Yes, things like regulated futures and non-equity options. They have a totally different tax treatment. It's called the mark-to-market rule.
Mark-to-market. Meaning they're treated as if they were sold at the end of the year, even if you didn't sell them.
Exactly. They're marked to fair market value on the last business day of the year. And the gain or loss has a special character.
The 60-40 rule.
Right. The gain or loss is always treated as 60% long-term and 40% short-term, no matter how long you held the contract.
Which is a huge benefit for a short-term trader.
A massive benefit. And because the contract is effectively sold and repurchased for tax purposes every year, the wash sale rules just don't apply to them unless you're in a very specific straddle situation.
Let's talk about straddles then. An offsetting position.
A straddle is basically any set of positions on actively traded property that offset each other. And the rules are there to prevent you from cherry-picking your losses.
So you can't just sell the losing leg of the trade and wait to sell the winning leg next year.
No. You can only deduct a loss on a straddle position to the extent that the loss is greater than the unrecognized gain on your other offsetting positions at year end.
So if I have a $10,000 loss, but an $8,000 unrealized gain on the other side,
you can only deduct $2,000 this year. The other $8,000 is carried forward.
It also messes with your holding period, doesn't it?
It does. The holding period for a position in a straddle doesn't even start until the straddle is closed. It's another anti-abuse rule to stop people from turning short-term gains into long-term ones.
So given all these complexities and gray areas, what's on the horizon? Any talk of regulatory expansion?
Definitely. There have been several legislative proposals to expand the wash sale rule.
To cover what?
Digital assets, most notably, cryptocurrencies. Right now, because the IRS classifies crypto as property, not a security, the wash sale rule technically doesn't apply.
So you can sell Bitcoin at a loss and buy it back 1 second later and still claim the loss.
For now, yes. But that is loophole number 1 on the list for Congress to close.
And what about the related party issue we talked about?
That's the other big target. Proposals aim to formally apply the wash sale rule across a whole list of related parties. Your IRA, your spouse, your dependents, certain companies you control.
So they're trying to codify what the courts are already doing with Section 267 and make it even broader.
That's the goal. It signals a clear move toward much tighter scrutiny on all these strategies.
Let's touch on one last planning point for active investors. The investment interest limit. What is it and why is it important?
It's vital if you use borrowed money, like margin, to invest. You can deduct the interest you pay on that money.
But there's a limit.
A strict limit.
Yeah.
Your deduction is capped at your net investment income for the year.
And what's included in net investment income?
Typically, it's things like interest you receive and ordinary dividends.
But there's a choice you can make, right?
Yes, and this is the key strategic element. You can elect to include your qualified dividends or net capital gains in that net investment income calculation.
Why would you do that?
To increase your limit so you can deduct more of your investment interest expense.
But what's the trade-off? It sounds too good to be true.
The trade-off is the tax rate. Qualified dividends and long-term gains get preferential, lower tax rates if you choose to include them in your investment income calculation to get a bigger deduction.
You give up the lower rate.
Exactly. Those gains are then taxed at your higher ordinary income tax rate. You have to run the numbers to see if trading a lower tax rate for a bigger deduction actually saves you money.
Okay, that brings us to the one question you should always be asking about this topic. When you're realizing an investment loss, how strictly must you define substantially identical to confidently avoid the wash sale rule, especially when you're dealing with all these modern interchangeable assets?
Because that economic distinction, whether it's between two ETFs tracking the same index or a common stock and a convertible preferred, that's what determines everything. It determines whether your loss is recognized now, deferred, or in the worst case, permanently disallowed. The rules aren't static, and future changes, especially for things like digital assets, will keep redefining that boundary.
So today we've really unpacked the complexities of that 61-day tax trap. We've clarified the huge difference between a loss deferral under the wash sale rule and a permanent disallowance under the related party rules. And we've highlighted how modern tools like different ETFs are creating these planning opportunities that might not be around forever.
I think the critical takeaway for you is that success here really demands meticulous record keeping. It's about timing and ownership structure. Don't rely on a technical loophole that could be closed next year. The economic substance of what you're doing, the idea that you truly, genuinely relinquish your position, that is what will ultimately determine if your tax planning holds up under scrutiny.